It's time for Smart Charts with Abigail Doolittle, looking at timely topics through the charts. And this week, Abigail, you're looking at the more global equity market.
You're right about that, Joe. We are taking a look at other markets outside of the U.S., especially specifics to stocks. And to do that, I'd like to welcome once again Ari Wald of Oppenheimer. Great to have you here as always. You know, and Ari, before we turn to your first chart, banks in Europe, where you think that there's an opportunity, so many of our other charting guests here, both Smart Charts and Charting Futures, are making the point that their clients are so bearish, and that from a contrarian standpoint, it's bullish. You, of course, have been correctly bullish for a couple of years now. Are you hearing the same sort of thing out of your clients, and do you also take it as a contrarian signal?
We do. We're seeing it in the polls. We're seeing it in the put call data. Every time the volatility hits, really, you have a sense of investors fearing that this is the next major downturn. But kind of how, as we see it, you got a lack of investor enthusiasm out there. You got interest rates that are finally stabilizing, an oversold economy, seasonal tailwinds, and the lead in what I wanted to talk to. Now you're starting to see global participation really starting to broaden out here.
So this is a true buy the dip opportunity, and that is shown extremely well by your first chart over a long-term basis. Let's take a look at this. I mean, that is, if you were going to buy a dip off of history, this would probably be it.
Well, here you go. Yeah, the European banking industry, this has been such a critical risk-on area of the market in recent years. And once again, we're basing at that red horizontal level, which dates back to the March 2009 low. And we see a lot of similarities to what you had in 2012 and 2016, these three-stage bases where you had a high-intensity low. The initial low was followed by a lower low, and then the snapback rally above the 200-day. Same thing with 2016, and I think we're having it once again. December 2018, that was the bang. I think August, more recently, that was the whimper, the less intense low, and now we're snapping back above the 200-day. I think the setup is there where you get European banks reversing higher.
And it looks like there's a little mini inverse head and shoulders pattern there that could pop higher to at least 100. Let's broaden out even more to emerging markets and take a look at your long-term chart here, because this looks like a breakout.
Not just Europe. Emerging markets as well. Here is the iShares Emerging Markets EEM. And what we have here, first thing to note about this one, this strength in 2017, that reversed a 10-year downtrend dating back to the year 2007. EN then peaked January 2018 and really had a textbook bear market. It declined coming into 2019, now stabilizing above there. We see potential. We see rotation opportunity, and I think that's going to be another tailwind for this global bull market.
I love that word, rotation. It seems to be hot right now. So you're saying that folks will be rotating into this area. If you had to give a target on levels higher, actually, let's turn to your next chart because it is more near term.
That's my trade. Yeah. So let's zoom in. Here's the same EEM ETF. It's a daily, just going back 2 years. There's the bear market in 2018. We reversed higher this year, and now we've just been base building for all of 2019. I have a 200-day moving average on here. It's flattening out. It's starting to creep higher. You still have to break above 45. That's the April peak. That would complete the base. I think on that move, you're talking about a move back into the 50s. That would project there. You get back into peak levels from 2018, and I'd place my stop at 41. That was the gap from late September, I believe it was. Want to hold above 41. So
it looks like this entire range, the battle between the bulls and the bears, you're saying is going to go to the bulls. I know that typically chartists, technicians don't talk about the what, but if you had to guess what could possibly break that entire range out. Well,
I mean, this has really been in the crosshairs of the U.S.-China trade war. I think the resiliency that we've seen would suggest to me that a lot of those concerns are already discounted and baked into the market. So any sort of resolution there, I think, would be that catalyst to the upside.
Perhaps a call on the trade war as well.